Hello, friends. A very happy 30th Founders Day to the friends and family members of Bambwani Securities Private Limited or BSPL India, as you know it in the internet domain. Unfortunately for us, we do not have any special occasion because our founder and promoter, who I'm honored to call as my dad, is in the hospital and has undergone 2 emergency surgeries. He's in the best possible hands, under the best possible medical attention, and God willing, he should be home, happy and healthy, back again to guide us to take the company to greater heights in the next decade. Going back to the markets, last week I advocated that the bulls were tightening their grip on the market, but they would need, like I mentioned in my Live Mint column, to provide more proactive buying support before the markets could actually scale higher peaks. This is borne by the market roundup window, which you see on your screen, which shows that the Nifty managed to scrape higher, but the Bank Nifty actually logged small losses. The US dollar index reacted downwards, or the Dixie, and the US dollar versus the Indian rupee also fell, which means the rupee was relatively stronger against the dollar. That cushioned all declines and created some amount of a feel-good factor in the market. The Indian 10-year benchmark bond yield continued to remain below the 7% mark, and that basically saw bond prices go up and give a small mark-to-market profit to banks. In spite of a weak dollar, crude oil and natural gas prices fell. Like I have been mentioning since 2021, I do not believe in a commodity super cycle, and therefore prices at higher levels are running into resistance. Gold and silver edged higher on a weak dollar on safe haven defensive buying. The NSE managed to log small gains in terms of market capitalization on a week-on-week basis. The market-wide position limits, or the risk appetite of traders, went up routinely by over 5% after the expiry week. The headline United States market indices rallied and provided tailwinds to the domestic markets. Now for our in-house indicators, starting with the MWPL, or the market-wide position limits. These are exposure limits utilized by traders as a percentage component of what is allowed by SEBI, the market regulator. Look at how the expiry week saw a bottom at 23.63, which is higher than the previous 4 expiries. And the week after expiry saw 28.95%, which is on the 2nd of June. The week ended 2nd of June. This is the highest in the last 20 weeks as the week after expiry. So, to Marshmallow traders, don't worry about the Marshmallow theory. It is explained in the pinned comment as well as in description below this video. So, 2 Marshmallow traders were definitely writing out bigger checks and showing higher risk appetite. Now, the index turnover with the futures turnover in stocks. Remember, these are cumulative figures for 3 concurrent series, which is June, July, and August. The turnover has fallen, which is not surprising because the markets failed to rally, and Wednesday and Thursday were actually down days when turnover tends to bottom out, flatten out a little bit. Also, the prior week saw a spike in turnover because of rollover. So traders tend to square up their trades in the expiring month and roll them over to the next month, resulting in double turnover. So you will see these spikes every 4 weeks. This is nothing but expiry. So the turnover is not really collapsed as such, but this is a routine phenomena. Now for the advanced decline ratio, and this is a weekly average, which means the average of all 5 trading sessions of the week. Although the index Nifty managed to log only 0.19% in gains on a week-on-week basis, the average weekly advanced decline ratio edged higher to 1.29, which means for every 100 falling shares, there were 129 gaining shares. So risk appetite of even the one Marshmallow traders appeared to have risen. So sentiments were optimistic in the week gone by. Should this continue, I think you can see follow-up buying coming in. This is a weekly chart. The daily chart of this advanced decline ratio is updated on my social media groups, particularly my free Telegram channel. Do make the effort of connecting with me out there. Now for the basis. Basis is nothing but the premium or discount prevalent in the near month futures compared to spot. The basis on both the indices rose, which is not surprisingly because traders have 3 full weeks in the new derivative cycle and they tend to pay a higher risk premium in the initial part of the series, and then this basis of course tends to slide down as the expiry of the prompt month futures comes closer. So the expiry being 3 weeks away, the basis has also risen because of short covering, as I have been posting on my daily social media posts that short covering has been largely responsible for cushioning the declines. Do note how the Nifty 50 has risen in price and the blue line showing the Nifty impetus has also risen, which means there was a certain amount of force in the Nifty buying. The Bank Nifty has logged net week-on-week losses, but the impetus has gone up, which means either the bulls attempted to push the Bank Nifty higher, but the price was sluggish, or there was actually higher momentum-based selling, forceful selling at higher levels, which resulted in the Bank Nifty closing with marginal losses. In any case, I have often written in my live mint columns that the market is like a bicycle and the two indices are like its two wheels. You cannot have one index rising and the other falling. It's like the front tire of the bicycle going forward and the rear one going backwards. That obviously results in the bicycle toppling down. So we don't want this divergence. We want a positive move correlation between these two, and therefore I would suggest that we await higher volatility in the markets because of the diverse movement of the indices. Now for another exclusive in-house indicator which you've learned to trust over the last 1.5 years, the LWTD or the Lift Weight Thrust Drag Index. Here again, this is a weekly chart. The daily one is updated on my social media channel, on my social media accounts, especially my free Telegram channel. Note how the LWTD has slowly but surely edged upwards to 0.10, which is above the zero line. Although the Nifty has come down, it has basically indicated that there is a very slow but steady rising buying support coming in at lower levels. So the markets are likely to see a little bit of optimism and downsides may see some amount of buying support coming in. Of course, follow-up action, like I wrote in my live mint column, follow-up action is particularly critical when the chart reading shows the price falling with the impetus rising. You basically, for a bull market, want to see the price, which is the blue line, and the impetus, which is the red line, both rising in tandem with each other. That, unfortunately, is not happening. Friends, in-house indicators done. I now come to the bond market, which saw the Indian 10-year benchmark bond yield stay below the 7% mark. Last week, remember, I told you the green candle should not be taken too seriously because it has come after 9 to 10 consecutive declines, and therefore some amount of pullback is expected. But this was the last full week before the RBI's Monetary Policy Committee, or the MPC, announces interest rates in India in the coming week itself. So the markets are basically showing you, by way of the 10-year benchmark bond yield, that the bond traders are not expecting a rate hike, and it's either a status quo, which is a high probability, or a very, very small probability that the rate might be cut. So let's watch the MPC meet announcement and then take a call. Friends, I now come to the Bank Nifty, which essentially lost 0.18% on a week-on-week basis, all thanks to the fall on Wednesday and Thursday, which was substantial in terms of magnitude compared to the green candles on the daily chart on your screen. So, as you can see, the 44,152 level, which I have marked as a dashed blue line, as a previous swing high where overhead supply was expected. Overhead supply is when traders trapped at higher levels are waiting with long positions, paying mark to market and carryover charges only to offload them when they break even. So overhead supply actually came in at 44,152 levels and the Bank Nifty has slipped below it. Now the price remains above the month-long moving average, which means the short-term outlook remains positive, and as of now, the 43,500 level is a rough and ready support to watch out for. Let's now go to the weekly chart on your screen, where again the 44,152 level has seen a great deal of pressure at higher levels. The large or relatively larger bearish candle is also a bearish engulfing candle because it's engulfing the previous candle's body, and the price remains at a critical overhead supply zone area. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium term outlook also remains positive for now. It's up to the bulls to provide higher degree of buying support and push the markets higher. So what we need is more money to pour into long positions before the markets can be proclaimed as siding up with the bulls. Friends, in the week before last, this index was at number 14 in our statistical beta list of most volatile counters that we maintain in-house. Last week, it rose to number 7 by 8 notches. That means the challenge level created by higher volatility actually rose, which means you need to be careful out there. The prices can gyrate wildly. Last week, I advocated an estimated range between 45,300 on the upside and 42,750 on the downside. In the coming week, I estimate a range between 45,175 on the upside and 42,700 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which managed to log gains of 0.19%. It rose on 3 out of 5 trading sessions, and like the Bank Nifty itself, fell sharply on Wednesday and Thursday in relative comparison to the gains of the previous and preceding days, which stands out as a pressure point. The price is below the 18,604 level, which I have been indicating to you as a last mile resistance area. We need to close above this consistently before bulls can be in the driver's seat. Taking a look at the weekly chart, here again, you can see that the 18,604 area marked by a blue dashed trend line is providing a significant hurdle on the upside. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is optimistic for now. In the week before last, the Nifty was number 16 on the most volatile counters list by statistical beta that we maintain in-house. It fell 2 notches to number 18. Not just because the volatility in the Nifty was lower, but because volatility in individual stocks rose, thereby making the Nifty appear a little less volatile. Last week, I advocated estimated range between 18,925 on the upside and 18,100 on the downside, which held perfectly well. In the coming week, I estimate a range between 18,950 on the upside and 18,125 on the downside. And here again, I suggest trading a slightly smaller hand because volatility may just be a little higher. Friends, I now come to the retail risk appetite, which they indicate by where the turnover is focused. In the futures space, the turnover has fallen sharply in the stock futures, followed by the index futures. So lower turnover in futures is also, like I mentioned earlier in the turnover segment, because the previous week was an expiry week, so traders tend to roll over from the expiring month to the next month, so turnover happens to be higher. Similarly, this week the turnover appears to be lower because expiry is over, but the fact that the stock futures turnover has fallen rather sharply. Where has risk appetite actually increased? The highest gain in turnover as a percentage of the total market turnover has come in index options, which is, relatively speaking, of course, the least volatile of all the derivative instruments. So traders were seen playing a rather cautious hand. If they were so convinced about a big bull market, they should have bought aggressively in higher risk instruments rather than lower risk instruments. There was actually a substantial fall in the stock options segment. That basically tells me that traders were not willing to take higher risk on account of higher volatility in the stock options. This is clearly a very guarded and playing it safe kind of a market. So we need basically more aggression from the bulls before we can go out and buy aggressively. Friends, now I will discuss what I would do in the week ahead. I would play a rather guarded and cautious hand in the coming week. I would wait for the RBI Monetary Policy Committee outcome and then take a call on interest rate sensitives, cyclicals, consumer durables, and particularly banks. I would continue to monitor stocks in the energy segment because commodity prices, especially energy, are likely to be volatile. Don't forget, there is an OPEC meeting on Sunday, the 4th of June, and that is likely to provide a lot of grist to the mills, as they say, and traders are likely to witness some amount of volatility in crude oil. I will continue to bet on either divergence or disproportionate movement in prices of oil and gas, which means both could move either in opposite directions, or one could move a huge percentage and the other could be a small percentage mover, which is likely to continue. And metal prices on the commodity exchanges might witness a slight uptick due to short covering in the commodity arena. I'm still not betting that this is a bull market in metals. It's premature to bet on that. Friends, I now come to the most popular segment of this video for the statistically oriented or statistically minded trader, wherein I give you 5 stocks that have gained the most amount of impetus on Friday, where you take big exposure, wait for small price moves, and 5 stocks that has lost the most amount of impetus on Friday, where you take small exposure with large exposure and wait for small price moves. This is for scalpers. This list is valid only for Monday, Tuesday through Friday. It is updated on our free Telegram channel. So impetus gainers, where you take small exposure, wait for large price move. The list is led by AB Capital, followed by Mahindra Finance and India Cements, Asian Paints and Escorts. Impetus losers list, where you take big exposure, wait for small price moves, led by Muthoot Finance, Adani Ports, Adani Enterprises, Gujarat Narmada Fertilizers and Tata Consultancy Services. Friends, how do our videos help you become better traders? We'd love to hear from you in the comments segment. Do let us know. And before I sign off, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And help me reach out to a wider audience by sharing my video with your friends and family. Thank you for your patience. Till we meet again in my next. This is Vijay Bambwani signing off for now. Have a profitable week. Bye-bye.